be fair value? It depends on the type of inputs used. Historical cost and fair value, there are pros and cons for both. Here there is just a recap of historical cost and fair value. One of the advantages of the historical cost is that it is objective, so there is no estimation, no estimates, because it's based on a transaction. But, of course, if we are preparing financial statements of a period and the transaction occurred 20 years ago, the fair value, the cost could lose some of its capacity to allow users to make estimates, forecasts. Okay? Fair value, of course, is a current measure. So, generally speaking, it is useful in order to, it is more useful in order to make forecasting, because it is an updated values. But the problem is that when the asset is not traded, and when so the market value is not present, and if the company has to use the level 2 or the level 3, this means that, of course, there is a certain degree of subjectivity. This is the problem of fair value. Okay? And for these reasons, the board that does not oblige to use fair value for all the assets. I repeat again, it is a big mistake saying that under IFRS, financial statements are based on fair value. This is a big, big mistake. Under IFRS, fair value is an important criterion, but it depends on the assets and the liabilities. For some assets and liabilities, it is forbidden to use fair value. For some others, it is mandatory. For some others, it's up to the company to decide. Okay? And, for example, if we go to E&I, and in particular, page 198, this is the beginning of the notes, okay? Reads what E&I says. Consolidated financial statements have been prepared under the historical cost convention, except for certain items that under IFRS must be measured at fair value. What does this mean? That E&I, when it is mandatory to use fair value, of course, uses fair value. But when there is an option, E&I uses always the historical cost. Is this clear for everybody? And this is BP, page 171. In this case, here there is, we are talking about derivatives, okay? So this is the part of the notes where BP highlights situation where the estimates and the judgment are more complex. And, of course, one of these situations is linked to the fair value, and in particular, fair value of derivatives that are not listed, not quoted. And BP says that the majority of these contracts are valued using models with inputs that include, of course, information available in the market. So level 2. But there are also some derivatives for which it is not possible to find the inputs in the market, and so the level is level 3. If we go to the 211, this is the notes about financial instruments, and in particular then derivative, the note 30. And if we go to page 213, okay, in this table you can see the fair value of the derivative, and some derivative are assets, some other are liabilities. But look, level 1, 2, and 3, and level 3 is not insignificant, because out of 12 billion of derivative that are assets, half are the fair value of half of this derivative is measured according to level 3. The same for derivative that are liabilities. This means that level 1, no subjectivity, it's the market price. Level 2, very small degree of subjectivity, because the inputs are observable in the market. Level 3, the subjectivity is big, because the estimates of the inputs are made by BP. If we compare BP and ENI, for example, in ENI, there are no derivatives with the level 3, only derivatives of level 1 and 2 of fair value. For BP, as you can see, more or less, more than half of the value of the derivative is determined according to level 3. So when you read financial statements, of course, in this case, you have to pay more attention, because the number depends on the estimate of the company. Is this clear for everybody? Here in class and also at home? Is it clear? The fair value hierarchy. Derivatives under IFRS, it is mandatory to use fair value for their measurements. We will discuss briefly at the end of the course. What is very, very important for me is the fact that there is a hierarchy for determining the fair value. And when you read financial statements, you have to pay attention to this hierarchy. In the case of ENI, level 3 is not used. In case of British Petroleum, level 3 is very, very, very important, because half of the derivative is measured according to level 3. Is this clear for everybody? Any questions? Students that are at home, it is very, very important when something is not clear that you interrupt me with the questions using the chat or by activating the microphone. Okay, and now we start with the analysis of the most important transaction of a company. And so we start with the fixed assets, or if you prefer, non-current assets. Non-current assets are property, plant, and equipment, or intangible assets. There is goodwill. Yesterday, I told you that under IFRS, goodwill is not considered an intangible asset, even if it's presented within the category intangible asset in the balance sheet. It is dealt with a specific standard. So it's important, it's an important non-current asset, but it is not a tangible asset. And then yesterday, when we analyze, I don't remember which financial statements, but we read an item, right of use asset. And yesterday I told you that the right of use asset is an item related to lease contract. So starting from today, little by little, we analyze all these type of items in order to understand the impact on balance sheet, income statement, cash flow statement, and of course also statement of changes in equity, even if in this case it is not so relevant, and notes. Okay? And we start with property, plant, and equipment. Then in this set of slides, there are some few indications about also government grants, borrowing costs, and a very particular type of property that is the investment property. Yesterday, when we discussed the list of items provided by IAS 1, we read also investment property, that is property that is rented to other companies. Property, plant, and equipment. And we start from probably one of the easiest standard, because it's at the end very similar the IFRS accounting treatment to the accounting treatment of other GAAP, Italian, Chinese, French, and so on. So property, plant, and equipment. The standard is the IAS 16. You are not required to remember exactly the number of the standards, but of course when I teach, I repeat it. But you are required to know that there is a specific standard about property, plant, and equipment. Please look at the agenda. Apart the nature of property, plant, and equipment, then we focus on the initial recognition. Yesterday, I told you that the recognition, initial recognition, is when an asset is recognized for the first time in the balance sheet or in the accounting of a company. So for property, plant, and equipment, we need to understand when a company has to recognize for the first time the machinery, the equipment, the cars, the plant, and whatever. Then we need to define the initial amount to be recognized. And according to the IFRS language, when we measure the initial amount, this phase is called initial measurement. Then, suppose that we buy a plant today. So today, It's when the plant is recognized for the first time in our balance sheet. And we need to determine today the initial amount of the plant, initial measurement. Then the plant is used for, 20 years. So at the end of each reporting period, at the end of 2021, 22, 23, 24, until the end of the useful life, we need to define the amount to be shown in the balance sheet. And this is the so-called subsequent measurement. Subsequent measurement means subsequent to the initial recognition. And eventually, after 20 years, 10 years, 35 years, I don't know, it is necessary to verify when the property, plant, and equipment must be eliminated from the balance sheet. And so this is the so-called due recognition. Okay? Keep in mind this structure because it is the same for all the standards. Initial recognition, when? Initial measurement, how much, but at the initial recognition. Subsequent measurement, how much, at the end of each reporting period. De-recognition, when the asset must be de-recognized. Okay? And the definition of property, plant, and equipment is quite easy. Tangible assets with a specific use within the entity, expected to be used for more than one period. Of course, that are not held for sale. Generally speaking, land, machinery, motor vehicles, office equipment, buildings, and so on. Initial recognition for tangible assets is quite easy. It's easy. Because tangible assets are recognized when it is probable that economic benefits will flow to the entity. And sorry, but if you buy a building, it's because you think not only that is probable, but that is certain that you will have benefit from the building. Otherwise, at least at the beginning, you don't buy the building. Is this clear for everybody? Tangible asset is something that we can touch, we can see. So it is very simple to demonstrate that the company expects to receive future benefits. For intangible assets, it's completely another story. But for tangible asset, land, machinery, buildings, plant, motor vehicles, and so on, is not a problem. And the same for the cost. Of course, if you buy, it is easier because there is an invoice. If you produce the asset internally, it is a little bit more complicated. But at the end, again, for tangible asset, it's not a problem to demonstrate that the cost can be reliably measured. Of course, without the probability of future benefits, we cannot consider the amount spent as an asset, but as a cost. But I repeat, for tangible asset, generally speaking, it is not a problem. Take into account and this part. I skip this part for some minutes, then I come back to this component approach. Because I want to discuss with you the initial measurements. The initial measurement means the definition of the amount that the company has to assign to the plant, land, machinery, or whatever, at the initial recognition. That is when the asset is bought or internally constructed. And the cost includes the purchase price, including import duties and non-refundable purchase taxes, minus, of course, discounts and rebates. Nothing to say. You should have analyzed this part during your previous accounting background, or if not, during the pre-course of accounting. Purchase price, including import duties, non-refundable taxes, minus discounts and rebates. Moreover, another important part is this one. The initial amount of an asset, a tangible asset, plant, property, equipment, includes also all the costs that are directly attributable to the asset. That is, cost that the company is obliged to incur if the company wants to use the asset. Suppose that the company buys a machinery, and the supplier is from USA. Our location is here in Turin. We need to pay not only the supplier, but we need to pay also the transportation. The transportation is a cost that is directly attributable to the asset. This means that this cost is not recognized in the income statement, but is part of the cost of the machinery. The peculiarities of IFRS is the third bullet point. The initial cost must include also the estimate of cost of dismantling, removing, restoring the site of which the asset is located. These costs are not incurred at the beginning. These costs are expected to be incurred at the end of the useful life. Okay? The problem is that the company knows the fact that it is obliged to incur into this cost starting from the beginning. So under IFRS, it is mandatory to include in the initial cost also the estimate of these future costs due to dismantling, removing the asset, and so on. So the company has an obligation to do something at the end of the useful life. And at the beginning, at the inception, at the initial recognition, the company needs to make this estimate. I'll give you an example. Suppose that company A buys a plant, very complex plant. And suppose that the purchase is done on 1st of January, year 1. There is a purchase price, suppose of 1,000. There are some directly attributable costs. Transportations, installations, preparation of the site, suppose for 50. Okay? And then the company estimates a useful life of 20 years. And the company estimates dismantling cost, removing cost, restoring cost, for example, for, I don't know, 200 euros. Okay, so dismantling, removing, and so on, cost, 250 euros. But pay attention, these 250 euros is the amount expected to incur at the end of the useful life. So this is the amount that the company expects to be able to be obliged to incur at the end of year 20. Is this clear for everybody? Okay, so how much is the initial amount of this plant, taking into account this slide and what IAS 16 states? How much is the initial amount of the plant? How much is? Any idea? For sure, we need to include the purchase price. For sure. For sure, we need to include the directly attributable costs, transportation, installation, preparation of the site. And then we should include also the removing costs, dismantling costs. I like the question mark that Shakil, sorry for the pronunciation of the names of foreign students, sorry, I don't know if the pronunciation is right or not. I like the question mark because it's not completely right to say 1,300. Why, in your opinion? What is the problem? Why we cannot simply sum up 1,050 and 250? Because 1,050 are costs already incurred today. 250 is an estimate of cost expected in 20 years. Okay? So we have a problem of present value. It is not the same to be obliged to pay 250 today or 250 at the end of year 20. Personally, generally speaking, I prefer to pay at the end of year 20. Do you agree? Okay? So it is not the value of the money is not the same along the time. €1 today is better than €1 tomorrow. Okay? So keep in mind that under IFRS, the time value of the money is very, very, very important. Keep in mind, who are the primary users of financial statements under IFRS. Who are the primary users of financial statements? Shareholders, lenders, and creditors. They are very sensitive to the time value of the money. Okay? So, when we determine the initial amount, we need to consider the dismantling, removing cost, but we need to compute the present value of this dismantling, removing costs. Okay? And, in order to compute the present value, we need an interest rate. Okay? It's up to the company to make this estimate. The interest rate must be consistent with the currency. It's not the same, euros, dollars, pounds, and so on. And the time is not the same, an interest rate for 1 year or for 20 years. Okay? Suppose that the interest rate is 3%. Uh, 3% here. Okay? Here. Okay. So we compute the present value. Do you know how to compute the present value of a future amount of money? Could you please tell me what I have to do in order to compute the present value of the dismantling, removing costs? Mathematics is important, is beautiful mathematics. Okay? It's a very important language that you need to know, in particular financial mathematics. What I have to do? Okay, thank you very much for students that are at home. Probably since I don't see your face, you are less shy compared to students that are here in class. Okay, the present value more or less it's the approach is the right one. So I need to use the future cash flow 250, and then it is possible to use two different ways. I need to divide this amount by 1 plus the interest rate, but taking into account the years, 20 years, okay? Or, if you prefer, that is the same, 250 like multiplied by 1 plus 3%, but I need to take into account the minus sign. Of course, the final result is exactly the same. Okay? As you can see, it is not the same to pay today or to pay in 20 years. Okay? So the amount of money that is equivalent to an outflow of cash in 20 years, if the interest rate is 3%, the amount of money that today is equivalent is 138. Okay? Look, if I change the interest rate, I change also the present value. Okay. The higher the interest rate, the lower the present value. Okay? So this is very important for companies when they prepare their financial statements. So, the initial amount of the plant is equal to 1,000 plus 50 plus 138. So the initial amount of the plant is 1,188 euros or millions or whatever you want. Is this clear for everybody? And pay attention. This is just another way of computing. The company recognized the plant for 1,000 according to the invoice of the supplier. So what is the counterpart, the other account used by the company for the purchase price? Debit and credit. Do you remember debit and credit? Okay. If a company recognizes 1,000 of plant because of the purchase price of 1,000, debit side, what is the account used in the credit side? What is the account used? I don't believe you don't know. You are simply shy. I don't believe, sorry? Payables, okay? Trade payables. It's the easiest transaction, okay? So, plant or whatever, in this case, plant. Here I use the debit side, credit side, okay? Plant for 1,000 and trade payables. I'm not considering the VAT, okay? VAT is important, but frankly, VAT is just a matter of paying in advance and then I have a credit toward the state. So I'm not interested here in the VAT problems, but of course there is the VAT, okay? Then, what about the accounting entry for the directly attributable cost, transportation and so on? 50 is the amount. What are the accounts to be used for the directly attributable cost? Don't be shy. I know. I don't believe you don't know. Not installments. If this is part of the cost of the plant, we agree. Look, our final goal is to have in the T account plant 1,188. Okay, so we need to use again plant, even if the invoice is for transportation. And again, trade payables, the same amount. The difficult part is the third one, not the first two. The third one is that in this way, think about the T account plant. We have 1,050, but we need to include in the amount of plant also the present value of the future expected dismantling, removing, and so on costs. This is the difficult part, because this amount is not paid today. We don't have an invoice. This is just an estimate. So this amount, in this case, is recognized under provisions. Okay? In this way, we can clearly understand the total obligation, better, the present value of the obligation of the company. The obligation, the expected obligation is 250. Okay? And this is the present value of the future obligation. Think about Eni, British Petroleum. Some companies that in the energy industry that have nuclear power central. Of course, not in Italy, but Enel, for example, that have some nuclear power plants around the world. EDF in France. Okay, I hope that you have read that some years ago in Germany, Angela Merkel decided to stop the production of energy using the nuclear power. I don't want to give you to express my personal idea on this type of energy, but what is for sure that for nuclear power plant or when Eni, British Petroleum, they start to extract oil and gas, today they generate revenues. But tomorrow they need to restore the site. And in that, those industries, these costs are very, very important. Under IFRS, it is mandatory to understand and to estimate the amount of this cost, not only for the asset side, but in particular for the other part, for the provision, so that the users of financial statements can understand that that's true, that today you are generating revenues and cash flows, but you have a big obligation in terms of restoring site, removing the assets, and so on. Is this clear for everybody? And for example, in the Italian GAAP, this part is forbidden to make this estimate. Okay, so this is a peculiarity of IFRS. Is this clear? Next Thursday, you will discuss an exercise, and I suggest you to start thinking about the facts. This is the estimate of the provision made on January the 1st, year 1. Okay? But if our estimate will be confirmed, how much is the amount that the company has to pay? That is the question of Nicola in the chat. Because if the estimate is confirmed, the company has to pay 250. But the initial recognition is only 138. Why? Because of the present value. So I don't want to give you the answer now. Think about this part. What is for sure is that this amount, the yellow, highlighted in yellow, is not the amount shown at the end of year one. This is the amount at the beginning of year one. Because this is the present value on January the 1st. The answer, but I give the answer, but not the accounting technicalities, okay? At the end of each reporting period, the provision, the amount of the provision, must be always equal to the present value of the estimate. But how much is the present value at the end of year one? How much is? If the estimate is still confirmed, is always, we start always from 250. We start always from 250. We need to make the present value 1 plus 3%. But what about the time at the end of year one? 19. So you are kindly invited to think how to manage the fact that on January the 1st, the provision is recognized for 138 because this is the present value for 20 years because we are making this analysis on January the 1st. But at the end of year one, the present value must be 142. Okay, so this is one of the task for the next, not lecture to be honest, but for the next office hours on Thursday morning. What about the subsequent measurement? At the end, quite easy, because in theory, it is possible a company can choose between the cost model and the revaluation model. But even if it is possible to use the revaluation model, only few companies have chosen the revaluation model. In Italy, for example, Intesa Sanpaolo is the most important bank in Italy. Some years ago, decided to use the revaluation model for some buildings. That's a very, very, very particular case. So I think that here, it doesn't make sense to spend time in applying a method, the revaluation method, that is complex in its technicalities, but that at the end, it is not used. Okay? So, luckily for you, the cost model is equal to the one that you have studied in your bachelor. So the cost is maintained. It is necessary to depreciate the cost, and if it is the case, it is necessary also to impair the asset. And in this slide, just to highlight the fact that the amount to be depreciated, in theory, is not the cost, but it is the cost less the residual value. Because the depreciation is simply a method in order to split the investment over the useful life. But if at the end of the useful life, the company expects to sell the asset at a residual value, the amount to be depreciated is the initial cost minus the residual value. But in most of the cases, companies estimate the residual value equal to 0. This is why, at the end, in most of the situations, it's the cost that is divided over the useful life. But why? Because the residual value is estimated equal to 0. Is this clear for everybody? And no exercises. The other part is easy. You can have a look. It's just about the derecognition when the asset is disposed of. Okay? So, important things. First, the initial amount includes the purchase price, the cost directly attributable to the asset, and the estimates of the dismantling, removing, and so on, the cost. Then, the cost model is the method used by the 99.9% of the companies. Under the cost model, the cost less the residual value must be depreciated. Viola, okay, you can activate your microphone.
Do you hear me?
Yes.
My question is, from the first year, how I have to compute depreciation? I mean, with the value amount of the present value, I have to consider it, because if I put in the balance sheet and I put all the value in the debit side in the plans, when I see that value, I think that I have to depreciate all, just to calculate all. Okay.
You are right, Viola. The amount to be depreciated is the cost, means the initial amount included in the plant. So in the case of the case that you have presented, the amount to be depreciated is 1,188. Okay, so if the useful life is 20 years, if the residual value is equal to 0, 1,188 is the amount that must be depreciated, because this is the cost for the depreciation purpose. You are right, Viola.
Oh, okay, thank you.
Other questions? Okay, in theory it is not so difficult. In practice, there could be some particular situations, and this is why for the next Thursday in the morning, in the office hours, you will discuss some exercises on property, plant, and equipment. Okay, and also in order to answer to this question, so how to manage the fact that the provision is initially recognized at 138, but at the end of year 1, we want to see in the balance sheet 142. Okay. This afternoon, office hours with Professor Tonelli, and for students that are at home, in Moodle, you can find the WebEx link created by my colleague. Okay, see you next Thursday in the afternoon, and we are available for all the questions. Have a nice afternoon with the office hours.